Google stock has experienced significant ups and downs recently. In the first half of 2024, it rose by 40%, but then dropped following a challenging earnings season for big tech. Now, investors are asking, is this decline a chance to buy at a discount, or should we expect more turbulence ahead? To understand this, we need to go back to the beginning. Google just isn't any old stock. It's one of those rare gems that's been climbing steadily since its IPO back in 2004. In fact, its first major uptrend saw a staggering 650% increase from its IPO in 2004 through to 2007. Now, I don't know about you, but I find the origin stories of these tech giants fascinating. Google was born in a Stanford University dorm, the brainchild of Larry Page and Sergey Brin. They started with a project called Backrub, a fascinating name, right? Which eventually evolved into the Google we know today. Here's a fun fact for you. The name Google is actually a play on the mathematical term Google, which refers to the number 1 followed by 100 zeros. Page and Brin chose the name to reflect their ambitious goal of organizing the vast amount of information on the internet. This name choice wasn't just clever wordplay, it was a statement of intent. They weren't just building a search engine, they were aiming to create a system that could handle and organize an unimaginable amount of data. In 2015, Google underwent a major restructuring, creating Alphabet Inc. as the parent company. This move was designed to make Google's various businesses more accountable and transparent. Under this new structure, Google remains the flagship, focusing on internet-related services and products like search, advertising, and YouTube. But Alphabet also houses a range of other exciting ventures in areas like life sciences and technology research. This restructuring wasn't just a corporate shuffling of papers, it was a strategic move that allowed Google to maintain its core focus while giving its more experimental projects room to grow and innovate. Now, let's talk about Google's IPO in 2004. This wasn't your run-of-the-mill public offering. Google decided to shake things up by using a Dutch auction system to price its shares. This approach was meant to make the process more democratic, giving smaller investors a fair shot alongside the big institutional players. The IPO was priced at $85 per share and raised a cool $1.6 billion, valuing Google at about $23 billion. Not too shabby for a company that started in a dorm, right? Then, as already mentioned, between 2004 and 2007, Google stock skyrocketed by 650% right off the bat from its IPO. That's a rarity for stocks. Most don't behave like that. So what was Google's secret sauce? First off, Google was consistently knocking it out the park with its financial results. Their pay-per-click advertising model was revolutionary, and as internet usage exploded, so did Google's revenue. They weren't just riding the wave, they were creating it. This pay-per-click model was a game changer in the advertising world. It offered unprecedented targeting capabilities and measurable results, making it irresistible to advertisers of all sizes. During this period, Google also expanded its services beyond just search. They launched Google Maps and Google Earth, and in 2006, they made a game-changing acquisition, YouTube. These moves helped Google diversify its revenue streams and cement its place at the heart of the internet. Their YouTube acquisition in particular was a masterstroke. At $1.6 billion, it seemed expensive at the time, but in hindsight, it was an absolute bargain. YouTube has become a cultural phenomenon and a major revenue generator for Google. But perhaps most importantly, Google became synonymous with internet search. When you need to find something online, you don't search for it, you Google it. This dominance gave them control over a huge chunk of online advertising revenues. It's hard to overstate how significant this was. Google isn't just a successful company, it has become a verb, a part of our everyday language. Then came 2008, and with it, the global financial crisis. Google stock took a massive hit, plummeting almost 70% between 2007 and 2008. It was a stark reminder that even the mightiest companies aren't immune to broader economic turmoil. This period was a true test for Google's resilience and the strength of its business model. But here's where Google's resilience really shone through. From that 2008 low to the high of 2022, Google stock climbed an eye-watering 2,350%. And remember, this period included the COVID-19 pandemic, which caused Google to drop over 30%. But even that couldn't keep Google down for long. Following the pandemic, the stock surged another 200%. What drove this incredible rise? Well, Google continued to innovate and expand into new markets. They made strategic acquisitions, maintained their dominance in online advertising, and pushed into exciting new areas like artificial intelligence and cloud computing. Plus, the overall market conditions were favorable for tech stocks during much of this period. Google's expansion into AI wasn't just about staying current, it was about shaping the future of technology. Their work on projects like DeepMind and Google Brain has put them at the forefront of AI research and development. This isn't just about creating cool tech, it's about developing tools and systems that could revolutionize industries from healthcare to transportation. In the cloud computing space, Google has been playing catch up with Amazon and Microsoft, but they've been making significant strides. Google Cloud has been growing rapidly, becoming a major player in a market that's only going to get bigger in the coming years. This diversification is crucial for Google's long-term success, reducing its reliance on advertising revenue. But even Google isn't invincible. In 2022, the stock faced its first major challenge in years, declining by 45%. This wasn't just about Google though. The entire tech sector was grappling with a perfect storm of global economic concerns, regulatory scrutiny, and changing consumer behaviors. Inflation fears, rising interest rates, and geopolitical tensions all contributed to a broader market downturn that hit tech stocks particularly hard. However, the bulls weren't ready to give up. They came charging back in at the end of 2022, pushing Google up 130% to its current all-time high in July 2024. This recovery was fueled by improving economic conditions, Google's continued strong financial performance, and its leadership in crucial areas like AI and cloud services. It was a testament to the company's fundamental strength and its ability to weather economic storms. And that brings us to where we are today. After reaching that all-time high, Google stock pulled back about 23% in July and August of this year due to a challenging earnings window for big tech. This had every influencer trying their hand at calling a market top. They love to fearmonger despite always failing and ending up on the wrong side of the market. Google then rebounded 15% and has since formed a base between $170 at the high end and $147 at the low end. Now, this is where it gets interesting for us as trend followers. If the stock breaks out of this base and starts moving up, we're looking at a potentially aggressive buying opportunity. I say aggressive because it's still below its all-time high, which can sometimes act as a resistance and push the stock back down. But here's where we need to think in terms of probabilities. Look at Google's history. It has a solid track record of performance. When Google trends, it tends to do so for years at a time. So if you decide to buy when the stock moves to $170, history suggests that you have a good chance of seeing it break through its current all-time high. Of course, there are no guarantees in investing, but the odds are in your favor for new all-time highs. If you are a more conservative investor, you might prefer to wait until the stock clears its current all-time high before buying in. This approach might mean missing out on some initial gains, but it also reduces the risk of buying into a false breakout. Looking ahead, Google's future is closely tied to major advancements in artificial intelligence and expanding its cloud computing capabilities. These AI advancements aren't just about improving existing products. They're about creating entirely new categories of products and services that we can't even imagine yet. In the cloud computing space, Google is aggressively expanding its infrastructure to compete with giants like Amazon and Microsoft. If they succeed in attracting more large enterprise customers, it could significantly boost their revenue. The cloud market is expected to continue growing rapidly in the coming years, and Google is well positioned to capture a significant share of this growth. Don't be surprised if we see Google push through $200 and even target $300 over the next 12 to 18 months. The potential is certainly there, but remember, this is just a potential scenario. As investors, we need to stay vigilant and adapt our strategies as market conditions change. It's also worth noting that Google faces some challenges. Regulatory scrutiny is intensifying, particularly around antitrust issues. There are concerns about data privacy and the company's market dominance. How Google navigates these challenges would be crucial to its future success. Another factor to consider is the broader economic environment. Interest rates, inflation, and global economic growth will all play a role in determining Google's stock performance. As we've seen in the past, even a company as strong as Google isn't immune to macroeconomic headwinds. The bottom line is that Google remains a powerhouse in the tech world with a track record of innovation and financial performance that's hard to beat. Its current position, poised for a potential breakout, makes it an interesting prospect for investors. But as always, it's crucial to do your own research and consider your personal financial goals and risk tolerance before making any investment decisions. Google may have faced a setback they need to recover from, but can a company rebound when its co-founder sells $1 billion worth of shares? That's exactly the case with Palantir. Watch this video to find out if the company can maintain growth in its current stock price.